Hello everyone, and welcome to episode 19. This week's episode will focus on the real enigma to trading, risk management, and money management. These two topics are among the most important aspects of trading, yet they are often overlooked and underrated by many traders. My goal with this video is to explain everything clearly so that you have no confusion left by the end. By the conclusion of this chapter, you will understand that managing risk isn't just about protecting or preserving your capital, it's also about giving yourself the opportunity and freedom to grow it. That's the essence of risk management. As always, I will break down every topic step by step. First, I'll cover an introduction, specific techniques, their purpose, and their importance. Finally, I'll show you how applying these principles can improve your trading performance. We'll also explore various risk models for both personal and professional accounts, so you will know exactly how to adjust your trading risk based on your trading context. Now let's get into today's chapter and discuss why risk management is so important for us as traders. First, we'll examine the purpose of risk and money management, or simply put, why we should care about it. The purpose of risk management is to prevent us from losing more than we can afford. This ensures we stay in the game longer and survive the unpredictable nature of trading. Trading by nature is uncertain. While we cannot control the markets, there is one thing we can control: the amount of money we lose on a given trade. Managing this amount is what we call risk management. Good risk management ensures that no simple trade or series of trades wipes out your account. It gives you the confidence to continue trading because you know your capital is protected. Risk management is not just about safeguarding your capital, it's also about ensuring long-term sustainability. As professional traders, we understand that trading isn't about making money on a single trade. It's about consistently managing both your losses and your wins over time. Proper risk management prevents wins from making you overconfident and losses from making you fearful. You could have the best strategy or trading system in the world, but without proper risk management, you'll eventually lose in the long term. Mismanaging your risk can lead to losing your account entirely. Losing capital is one problem, but losses also affect your emotional state and psychology. This can make things worse, leading to inconsistent behavior and irrational, impulsive trading decisions. Such decisions often result in further losses, creating a vicious cycle of losing streaks. This is what we refer to as the risk of ruin. To avoid these pitfalls, proper risk management is essential. It ensures you don't fall victim to these challenges and helps you maintain both your financial and emotional resilience. Now let's move on to the next topic and address some common misconceptions about risk management that many traders have. The first misconception is the belief that having a high win rate automatically guarantees success. Don't get me wrong, winning trades are great, but they don't tell the whole story. You could have a high win rate and still lose money if you're not managing your risk properly. It's about finding the right balance between your win rate and your risk to reward ratio. Even if your win rate isn't exceptionally high, you can still be profitable as long as your winners are significantly larger than your losses. This is only possible if you maintain a proper risk to reward ratio. A high win rate alone does not guarantee profitability. In fact, traders with a relatively low win rate can still succeed if they manage their risk effectively. Your focus should always be balancing your win rate and risk to reward ratio, not just the number of winning trades. It's not about how often you win, but how much you win when you do. For example, even with a win rate of 40 to 50%, you can still come out ahead if your risk to reward ratio is solid, meaning your winning trades are worth at least 2 to 3 times more than your losing trades. Focusing solely on win rate is like seeing only half the picture. Trading is about working smarter, not harder. It's crucial to consider both your win rate and your risk to reward ratio and ensure they are aligned. We will revisit this concept later in this discussion. The second misconception is the idea that risking more on each trade will lead to higher gains. In the short term, this might seem true, especially if you're on a winning streak. It can feel tempting to increase your risk to chase bigger profits. However, when a losing streak inevitably comes, and it will, it can spiral your account out of control if you're risking too much per trade. This can lead to devastating consequences, not just for your capital, but also for your emotional and psychological state. The combination of significant capital losses and a fragile emotional state is one of the worst situations that a trader can face. To avoid this, you need a proper risk management plan that safeguards both your capital and your mental resilience. This balance is vital for the long term in trading. Recovering from a significant drawdown is much harder than avoiding one in the first place. For example, if your account is down by 20 to 30% or more, it takes disproportionately more effort to return to break even. This is what's known as the risk of ruin. Recovering from large drawdowns isn't just about making back the lost money. You're working with a smaller capital base, and your mental state is more vulnerable, which can lead to irrational and impulsive decisions that create further losses. While it may be tempting to think, I'll just risk more and recover faster, that mindset is a trap. Long-term success in trading requires consistency. Preserving your capital through steady and disciplined risk management ensures you stay in the game and not just survive, but thrive. As a professional trader, it's important to remember that trading isn't about hitting home runs every time. It's about protecting your capital from striking out. Slow and steady wins the race. Trading is a marathon, not a sprint. It's about the long-term performance, not the short-term wins or losses. Let's now discuss the differences between gamblers and traders. While often confused, their approaches and mindsets are fundamentally different. Gamblers take impulsive risks driven by luck and hope, with little planning. Traders, in contrast, calculate risk using tools like stop losses, position sizing, and structured strategies to protect their capital. Their focus is on long-term success and consistent gains. Gamblers are emotional, chasing quick wins and adrenaline rushes. Traders rely on discipline and logic, following structured systems to make smart, calculated decisions, even in emotionally challenging markets. That said, many traders will struggle to maintain this discipline, often acting impulsive and suffering losses. Gamblers depend on hope, not a reliable system, while traders operate on probabilities, clear rules, and defined strategies. Traders assess the odds and act objectively rather than relying on luck. Gamblers focus on short-term gains, ignoring long-term consequences. Traders take a long-term view, prioritizing sustainability and consistent profitability over time. Success for traders isn't about one day, but building enduring returns. Gamblers are a lot more likely to lose everything, doubling down on losses with reckless behavior. Traders, however, use risk management to ensure no single loss threatens their account, allowing them to survive tough periods and thrive in favorable ones. At first glance, trading and gambling may seem similar, but the differences are clear. Trading is built on strategy, discipline, and survival, while gambling relies on hope and emotion. Professional traders understand that hope isn't a strategy, success demands methodical, calculated actions. Finally, this comparison applies to professional traders, not beginners or so-called gurus. Many traders unknowingly behave like gamblers. Ask yourself, are you approaching the market with the logic and discipline of a professional trader, or falling into a gambler's mindset? Be honest, confront your mistakes, and commit to improving. Only then can you become consistently profitable. Let's look at this slide, which compares two equity curves, one for a gambler and the other for a professional consistent trader. On the x-axis is time, and on the y-axis is performance. The gambler's equity curve is highly volatile, with extreme peaks and valleys. Massive wins are often followed by catastrophic losses that can wipe out 10% to 20% or more of their capital in just a few trades. This inconsistency not only hurts their balance, but also their emotional stability, leading to impulsive decisions and hope-driven trading, a strategy doomed to fail. In contrast, the professional trader's equity curve shows steady upward growth. The gains are gradual and sustainable, with no extreme spikes or dips. Professional traders avoid excessive risk, maintain strong risk management, and trust their system even during drawdowns. They treat losses as part of the process and focus on consistent, long-term profitability. The core difference is perspective. Gamblers chase a quick win at the cost of stability, while professional traders prioritize steady growth and capital preservation. Now compare your own equity curve. Does it resemble a gambler's volatility or the trader's steady climb? This comparison can help identify areas for improvement. Next, let's discuss key risk management concepts essential for disciplined trading. The win rate is the percentage of profitable trades. For example, if 40 out of 100 trades are profitable, the win rate is 40%. However, a high win rate doesn't guarantee profits because it must be evaluated alongside the risk-to-reward ratio. The risk-to-reward ratio measures the relationship between the potential reward and the risk. For instance, risking $1 to earn $3 gives a 1 to 3 ratio. Even with a lower win rate, profitability is achievable if winners consistently outweigh losses. Risk per trade refers to the percentage of capital risked on a single trade. Over-risking can lead to large losses, while consistent risk allocation preserves stability. Increasing risk after losses or wins is a common emotional mistake that often backfires. Position sizing involves calculating trade size based on account size, risk tolerance, and stop-loss level. Whether trading shares, lots, or contracts, position sizing ties together win rate, risk to reward, and risk per trade to ensure responsible risk management. Mastering these concepts provides a clear framework to minimize risk and maximize long-term profitability. In this slide, we explore a table that highlights the critical relationship between risk to reward ratio and win rate, offering a comprehensive understanding of their impact on trading performance. This table is pivotal for grasping how these two factors interact and why risk to reward ratio often outweighs win rate in ensuring consistent profitability. On the x-axis of the table, we have win rates ranging from 10 to 90%. Meanwhile, the y-axis represents various risk to reward ratios, starting from negative, e.g. 2 to 1, where you risk $2 to gain $1, and progressing to positive ratios like 1 to 3, which is risking $1 to gain 3. The chart is divided into 3 sections: red areas for unprofitable scenarios, yellow areas for break-even scenarios, and green areas for profitable combinations. The table illustrates that focusing solely on win rate without considering risk to reward ratio can be misleading. For instance, a high win rate like 60% may still result in losses if the risk to reward ratio is negative, for example 2 to 1. Conversely, a low win rate, such as 30%, can yield profits if coupled with a strong risk to reward ratio, like 1 to 3. This insight reshapes the conventional understanding of trading success and underscores the importance of striking a balance between these metrics. For example, with a 1 to 2 risk to reward ratio, you only need a 40% win rate to be profitable. This is because your winning trades compensate for the losses, even when you lose more trades than you win. If you risk $1 to gain 2, losing 6 out of 10 trades still leaves you in profit due to the larger payouts of winning trades. The optimal risk to reward ratio for many traders is often 1 to 3. At this level, even a 30% win rate, often considered poor, can lead to profitability. This is because the reward from winning trades outweighs the losses from the losing trades. For instance, if you take 100 trades and win only 30 while losing 70, the profit from the winning trades at a 1 to 3 risk to reward ratio still exceeds the losses, ensuring a net gain. While higher risk to reward ratios like 1 to 4 or 1 to 5 can further enhance profitability, they often require greater precision, and they also do come with lower win rates, making them a lot more challenging to maintain consistently. Thus, many traders settle for a sweet spot like 1 to 3. That balances profitability with a manageable win rate. The takeaway here is clear. The true enigma of trading lies not in the charts, but in the mastering of the relationship between risk to reward ratio and win rate. By developing a system with sustainable win rate and a strong risk to reward ratio, traders can achieve consistent profitability over time. It's not about chasing perfection, but about aligning your strategy with your trading psychology and risk tolerance, ensuring discipline and consistency in execution. Let's now move on to the next slide and discuss a crucial aspect of risk management and trading, the concept of risk ruin. This refers to the probability of blowing up your account to a point where recovery becomes nearly impossible. Over-leveraging or trading too much risk per trade significantly increases the risk. Once you hit that point, regaining what is lost, let alone making profit, becomes extremely difficult. The risk of ruin differs between personal and prop accounts. With personal accounts, you have more flexibility since there are no set drawdown limits, but it's still essential to be disciplined and focus on capital preservation. It's your own money at risk, so survival and accountability must remain a priority. Prop accounts, on the other hand, come with strict rules like maximum drawdown limits, typically around 10%. These rules are designed to protect the prop firm's capital, requiring traders to be more conservative and disciplined. If you hit the drawdown limit, you're out, leaving little room for error. You cannot approach prop accounts like personal ones because the stakes are higher and limits are tighter. Avoiding risk of ruin is essential because the math behind recovery is unforgiving. If you lose 10% on your account, you need an 11% gain to be break even. A 50% loss requires a 100% recovery because you're working with a smaller capital base. The deeper the drawdown, the harder it is to recover. For instance, a 70 to 75% loss would demand a 400% gain to return to your starting point. At that stage, the pressure becomes immense and the odds are stacked against you. This is why protecting your capital and managing your risk is vital. Small losses are manageable, but large ones snowball and become exponentially harder to recover. The goal is to avoid reaching a point where recovery feels out of reach. By staying disciplined, managing risk, and avoiding over-leveraging, you can keep your account alive and maintain a chance at long-term success. Ultimately, survival is key in trading. The smaller the drawdown, the easier it is to bounce back and stay in the game. Avoid huge losses at all cost. Taking small manageable losses is always better than chasing massive gains just to recover. Protecting your capital gives you the best shot at thriving in the markets. Moving on to the next slide, here we will examine the risk of ruin table. This slide explains what the risk of ruin is, how it works, and why you should be aware of it. In the following slide, we will discuss its importance and benefits. The first thing to understand is that the risk of ruin is calculated based on 4 key metrics: your risk per trade, maximum drawdown, win rate, and risk to reward ratio. These 4 metrics are essential for calculating your risk of ruin. To do this, you should perform weekly and monthly reviews, gather as much data as possible, and use that data to calculate your risk of ruin using a risk of ruin calculator. Simply input the values into the calculator and it will provide a percentage value. To illustrate, let's look at a specific example. In the risk of ruin table, the risk per trade is set at 0.5% and the maximum drawdown is 10%, which is the typical drawdown limit for most platforms. The table shows how these factors, combined with different win rates and risk to reward ratios, affect your risk of ruin. For instance, if your maximum drawdown is 10% and your risk per trade is 0.5%, the table shows that it would take at least 20 consecutive losing trades to blow your account. However, if your win rate and risk to reward ratio place you on the losing side, your account equity will decline, and you risk hitting the 10% maximum drawdown limit. For example, with a 20% win rate and a 1-to-1 risk to reward ratio, the chance of 20 consecutive losses is 6.73%, which may seem low. However, the important metric here is your risk of ruin percentage. In this scenario, the risk of ruin is over 90%, meaning there is a very high probability of blowing your account. Even if your win rate improves to 20% with a 1-to-2 risk to reward ratio, your risk of ruin is still over 85%, which is dangerously high. Similarly, with a win rate of 30% and a 1-to-1 risk to reward ratio, the risk of ruin remains above 85%, indicating that such a system is highly unprofitable in the long run. Now consider a 30% win rate with a 1-to-2 risk to reward ratio. In this case, the risk of ruin becomes moderate with a value above 70%. This is still high and signifies a significant risk of losing everything, even when risking only 0.5% per trade. If your win rate is 30% with a 1-to-3 risk to reward ratio, your risk of ruin drops below 50%. This is a more favourable scenario as it reduces the likelihood of blowing your account significantly. For a win rate of 40% with a 1-to-3 risk to reward ratio, the risk of ruin falls to less than 30%, which is considered very low and highly desirable. Finally, with a win rate of 50% and a 1-to-3 risk to reward ratio, the risk of ruin is virtually non-existent. In this scenario, the chance of reaching a 10% drawdown is 0, provided you consistently follow your plan. To summarise, always aim for a system where the risk of ruin is below 50%, as this signifies lower chances of blowing your account. Systems with a win rate of 50% and a 1-to-3 risk to reward ratio are ideal, as they ensure long-term profitability and stability. Let's move on to the next slide and discuss why understanding your risk of ruin percentage is so important for your trading system. This knowledge benefits your trading approach in several key ways. First, risk of ruin is critical for capital preservation. It ensures a few bad trades won't completely deplete your account, allowing you to stay in the game for the long term. Protecting your capital should always be a top priority. It also plays a key role in psychological preparedness. Knowing the potential for losses helps you stay calm during drawdowns and prevents impulsive decisions. This awareness fosters discipline, helping you to manage emotions and maintain a level-headed mindset even during challenging periods. Monitoring your risk of ruin helps measure the performance of your trading system. If it remains high or increases, it's a clear sign your strategy needs adjustment. This feedback will enable you to refine your approach, identify weaknesses, and improve your performance over time. Finally, understanding risk of ruin instills accountability. Knowing the possibility of blowing your account reinforces the importance of sticking to risk management rules. It encourages careful trade evaluation and responsible decision making, preventing a spiral of losses that could lead to a disaster. In short, understanding risk of ruin isn't just about avoiding losses. It prepares you mentally, improving your system through consistent evaluation, and keeps you accountable. This knowledge strengthens discipline, enhances your approach, and ensures you remain in the game for the long term. Let's now shift focus to drawdowns. A drawdown refers to the decline in your account's equity from its peak to its lowest point before recovery. Simply put, it's a dip in your balance when trades go against you or losses accumulate. There are two key types of drawdowns to understand. The first is maximum drawdown, which measures the largest drop in performance over a given period. This method highlights the worst case scenario, how much you could lose during a rough patch even when following your plan. Being aware of this prepares you mentally, so instead of panicking, you remain disciplined and composed, focused on surviving and recovering over time. The second is average drawdown, which looks at typical declines from peaks to troughs. By analysing this, you gain insight into your system's normal losing streaks. For instance, if data shows regular streaks of 3 to 5 losing trades, you'll be less alarmed when it happens, treating it as a natural occurrence rather than a cause for concern. For instance, if data shows regular streaks of 3 to 5 losing trades, you'll be less alarmed when it happens, treating it as a natural occurrence rather than a cause for concern. Staying professional during losing streaks is crucial. Don't deviate from your system, hesitate to execute trades, or impulsively adjust your risk. Increasing or decreasing risk out of fear or overconfidence can amplify losses and psychological strain, pushing you closer to risk of ruin. Poor emotional control combined with poor risk management can be detrimental to long-term success. Drawdowns are significant for two reasons. First, they are essential for risk assessment. Knowing your maximum drawdown helps you gauge your risk exposure and set appropriate limits. Second, they challenge your mindset. By preparing for drawdowns through data analysis, you'll remain steady, understanding they're a natural part of trading. In summary, understanding drawdowns helps you manage your risk, stay emotionally composed, and stick to your plan with confidence. This preparedness ensures you can navigate the ups and downs of trading and remain in the game for the long term. Now let's move on to the next slide and discuss something truly practical and actionable. Risk management models. These models are built upon the foundational concepts that we've explored, such as win rate, risk to reward ratio, drawdowns, and the critical importance of capital preservation. The primary goal here is to provide you with a practical framework that you can seamlessly integrate into your trading system. Whether you're managing a personal account or trading on behalf of a prop firm, these models are dynamic and designed to adapt to either scenario. They are crafted to ensure consistency and discipline, regardless of your account type. Before we delve into the specifics, let's revisit the core principles we've covered so far. Understanding your risk per trade, being mindful of risk of ruin, and appreciating the role of drawdowns are essential to effectively apply these frameworks. These models are not standalone concepts. They rely on integration of all these elements to function effectively. Each risk management framework is designed to help you evaluate and set clear boundaries for the level of risk you're willing to take. Beyond that, they allow you to make well-informed decisions aligned with your trading style, financial objectives, and overall risk appetite. To accommodate diverse preferences and risk tolerances, I've outlined several models that range from conservative to aggressive approaches. This ensures that no matter where you fall on the risk tolerance spectrum, there's a strategy tailored to suit your needs. Whether you prefer a more cautious path or a slightly more assertive approach, these models will help you structure your trades effectively. The overarching aim is to minimize the likelihood of encountering catastrophic losses or hitting your risk of ruin, while simultaneously positioning you to achieve consistent profitability. These models are practical, adaptable, and most importantly, built to help you navigate the market with a structured and disciplined mindset. Let's explore this example of a conservative and realistic trading model, which is designed to illustrate how a structured risk management framework operates effectively. The metrics in this case study are adaptable, but they highlight how a disciplined approach can sustain profitability while minimizing your risk. The model assumes a win rate of 40%, a feasible and realistic goal. This win rate implies that for every 100 trades, 40 are profitable. Achieving this is well within range for traders who follow structured methodologies, such as those trading candle ranges or other strategies I've shared. With diligent practice, backtesting, and adherence to these techniques, traders can potentially exceed this rate, moving towards success rates of 70% or even higher. The risk to reward ratio in this model is set at an average of 3 to 1, meaning that for every unit of risk taken, the trader aims to gain 3 units of reward. While the ratio used here is 3 to 1, for illustrative purposes, it can be adjusted based on the trader's strategy and goals. Ratios like 2 to 1 and 4 to 1 can also be effective depending on individual preferences and market conditions. The model anticipates trading frequencies at 3 to 4 trades per week. This provides a balance that avoids overtrading while still capturing enough opportunities to capitalize on favorable market setups. The risk per trade is set conservatively at 0.5% of the account balance, aligning with a capital preservation philosophy that protects traders from excessive losses. A maximum drawdown of 10% is established as a safety limit, ensuring that traders remain within boundaries that safeguard their overall equity. Calculations show that these parameters, the risk of ruin, defined as the probability of reaching a maximum drawdown of 10%, is only 3.62%. This extremely low probability demonstrates that the model is highly sustainable, provided the trader executes consistently and avoids emotional or impulsive decisions. The approach is robust and designed to protect the account while allowing for steady growth. This model is practical because it not only relies on overly optimistic metrics, it is grounded in achievable benchmarks such as a moderate win rate and a reasonable risk to reward ratio, making it accessible to traders of various experience levels. Its structure ensures that traders maintain focus and discipline even during challenging periods marked by inevitable drawdowns. This framework is also flexible. Traders may find it adaptable to lower their trading frequency and higher their reward targets, while scalpers can modify it for faster paced strategies with tighter risk controls. Regardless of the trading style, the model emphasizes the importance of sticking to a structured approach and preserving capital while aiming for profitability. This conservative and realistic trading model showcases the power of disciplined trading. It minimizes the chances of account failure while providing a pathway to consistent performance. By following the metrics and principles outlined, traders can confidently navigate market fluctuations, stay composed during drawdowns, and achieve sustainable success. Now let's move on to the final slide. Now that we've discussed everything, let's wrap things up with some key takeaways. At the end of the day, risk management is the foundation for long-term success in trading. It doesn't matter how great your strategy is, if you don't manage your risk, it will all fall apart. You need to know your risk per trade and understand how it impacts your account in the long run. Every trade you take should fit within your overall risk tolerance. It's crucial that your win rate and risk to reward ratio align with those limits, especially when considering your drawdown limits. One of the most important things to remember is the risk of ruin without proper risk management. Without it, even a profitable system can end up wiping out your whole account. So it's not about making money, it's about ensuring you don't lose it during rough periods. Also keep in mind that your risk management strategy should depend on the type of account you're trading. If you're working with a personal account, you have more flexibility, but you still need to prioritize capital preservation. On the other hand, if you're trading with a professional account, the rules are much stricter and you'll need a much more conservative way to stay within the drawdown limits. So always be mindful of risk, protect your capital, and stay disciplined. That's the key to staying in the game for the long term. This is the real enigma to trading. Not a lot of people will tell you this. They'll all tell you it's about a strategy, but no strategy works without proper risk management. Thanks for watching. I'll see you in the next one. This is the Enigma. Would you like to earn up to $10,000 just from sign-up bonuses? How about copy trading alongside professional traders like myself and these experts right here? With ByteFi, it's easier than ever. That's not all, there's no KYC required for all regional users. Plus, you'll enjoy a lifelong 20% cashback on every trade you make. And when you sign up, you'll also get a 10% deposit bonus. This totals 30% of your total trading budget. The link is in the description below.